All right, good morning, students. We're going to go ahead and get started. If you could get out your notes from the last couple of days on macroeconomics. Let me go ahead and share my screen here. We had been talking about GDP, inflation, and unemployment. And yesterday you did the data sheets. You turned those in. Anybody else that did not turn those in, go ahead and make sure that you do drop those off on my desk. So we're going to transition from inflation to taxes. And most of you know and have a decent understanding of what taxes are. In the Constitution, it says Congress has the power to lay and collect taxes, duties, and excises. Duties and excises are simply different types of taxes, and on imports, goods and services, those sorts of things. The reason why we have to have taxes, obviously, is to pay for government services, police protection, build roads, parks, bridges, pay teachers, for example. So we need this revenue, which is just kind of a fancy word for income. We need this money to pay for government services. So a tax base, this next definition, is people and things that you can tax. And when we normally hear this word a tax base, we're talking about probably a location. Like, for example, California has a bigger tax base than Connecticut. There's just more people. Or Higgins Lake has a bigger tax base than maybe Lake St. Helen. Higgins Lake has more expensive homes to tax, property taxes, than maybe the homes on Lake St. Helen. No, not a knock on Lake St. Helen, it's just Higgins Lake is one of the most premier lakes in Michigan. And so the property values to tax are higher. So we would say that Higgins Lake has a bigger or a better tax base than Lake St. Helen. Income tax, just as it sounds, it's a tax on your income. It's the most popular type of tax. Many states do an income tax, and of course, the federal government, the United States, does an income tax through the IRS, Internal Revenue Service. Most of you know and understand a sales tax. In Michigan, it's 6%. So when you go to the gas station to buy a pop in the morning, pop's $1, and you go up there and they ring it up and it's $1.06. And so that would be the taxes coming in. Property tax. Property tax are one of those weird taxes where if you buy real estate, which is land or a house, then every year your local government, your township or your city or county are going to charge you a property tax on that property. So imagine if you bought a car. And they don't do this, but imagine if you bought a car and every year the value of your car meant that you had to send the government some tax money on that car. We don't do that, but we do that with property taxes. Corporate tax are just an additional tax on top of what a corporation might pay. Corporate taxes are at different levels and they're generally by state, on a state by state basis. That's why some states are tax havens and are popular for corporations to put their headquarters there because their corporate taxes might be lower than another state's corporate taxes. Sin tax. So this is just a nickname. It's not really a particular type of official tax, but there are taxes on things. There are these excise. But first of all, excise tax is a sales tax is an excise tax. An excise tax are things that are taxes on things like property, um, goods and services that you might buy. And some goods and services that you might buy are liquor, tobacco, and marijuana in Michigan. And some of those things might not exactly be good for you. And so when the government taxes those things, they generally do so at much higher levels. And so knowing full well that the people who purchase, the customers of liquor, tobacco, and marijuana, would pay any amount of tax. And so these tend to be successful taxes by the government in that it doesn't cause too much of a decrease in demand if you increase those taxes. So we call those the sin taxes because getting back to the old biblical word of committing a sin. There's also a very famous phrase, there are only two certainties in life, and those are death and taxes. That's a pretty popular idiom, phrase, quote that was made popular by Benjamin Franklin. So we're going to put taxes basically in three categories. Now there's many different types of taxes, as I just showed you a list of some, but we can put them into three general categories. That's of how they're calculated: proportional tax, progressive tax, and then the regressive tax. A proportional tax is also referred to as a flat tax because it is a flat percentage, 1% for everybody. Doesn't matter if you're rich, doesn't matter if you're poor. In Michigan, for example, the flat tax is 4.25% on your income. Now, of course, if you are poor, you're going to pay less. Your 4.25 will be less than the 4.25% of a millionaire, a rich person. So the rich person is still going to pay more in dollars when they pay a proportional tax, but it'll be the same proportion of their income, 4.25% of a rich person's income versus 4.25% of a poor person's income. There's a considerable amount of support, not just in Michigan, but across the country, that believes that we should be on a proportional system. Michigan is, the United States government is not. The United States government is on the progressive, has a progressive tax. A progressive tax is one where you would hear terms tax brackets. The amounts that they charge depend on how much income that you make. And in general, the less you make, the lower the percentage that is collected. The more you make, the higher the percentage that is collected. In 2018, for example, the poorest Americans would have been taxed at 10%, and the richest Americans would have been taxed at 35% at their highest income levels. And I'll explain that here in a few more slides. The regressive taxes are ones that they're kind of backward, and in that the percentage increases as your income decreases. Now that sounds really weird, but the main reason for this is most regressive taxes are a flat dollar amount. And what I mean by a flat dollar amount is that it might be, for example, $25. This tax might be a $25 garbage tax. All right, everybody has to pay this $25 garbage tax. Well, for the poor person, that $25 garbage tax is more of a hit, more of a percentage of their salary than their income than for a rich person. For a rich person, that $25 garbage tax is absolutely, nothing. It's peanuts. So I want to show you this quick video. This video is from Tennessee, and it's a pretty interesting video. Let's turn up my sound here. Let's skip through this commercial. Here we go.
Also, a Tennessee family. This is an unbelievable story, folks. And a Tennessee family watched their entire house just burn to the ground last week when the city's fire department refused to respond. Gene Kranick said he begged the city of South Fulton to send firefighters to put out the fire. Kranick lives in the county and chose not to pay the yearly $75 for city fire protection. So because he didn't pay the $75, the city fire department did not respond. However, firefighters did show up and the flames spread to a neighbor's property who had paid the fee. The city's mayor said county residents cannot receive city fire protection unless they pay for it.
Oh my goodness.
And anybody that's not inside the city limits of South Fulton, it's a service that we offer. Either they accept it or they don't.
The family who lost their home say they don't blame the fire department. They say they were just doing their jobs. Our viewers, though, are waiting.
Okay, so you get a good idea of what's going on there is somebody didn't pay their tax on their fire tax in that particular city in Tennessee. And so that's another discussion that we could have for another day. But basically that $75 firefighting fee or tax is a bigger burden on poor people than it is for rich people. So to explain that a little bit further, most of these taxes fall under the sales or excise tax category. So for example, and this goes across the top here, the lowest income, the poorest people would be in this column right here, second, and then you got your middle class right here, incomes up to 75,000. Above that, you start getting into your wealthy classes and then the top 1%. And you see these, if, for example, one of the worksheets I'm going to give you tomorrow is going to talk about, what if a poor person buys a pickup truck and a rich person buys the same pickup truck? They're both going to have to pay a sales tax. And again, in Michigan, that's 6%. So who's going to bear that tax as a greater burden? Obviously, the poor person is. And so for the rich person, it might be, excuse me, for the poor person, you look here, it might be 6.2% of their income. And then as they get more wealthy, it becomes a smaller part of their income, and all the way to a wealthy person where it'd be such a tiny portion of their income. So we call this a regressive tax. And generally they're found on sales taxes and excise taxes because they're a flat rate or a flat dollar amount. Income taxes, on the other hand, at the federal level are progressive. So you'll notice here the poor people at 0.7%, 2.1%, 2.7, all the way on up to 3.8%. The highest income earners would pay the greatest percentage. To see what this looks like in an actual table, to hopefully that you can understand this. The proportional tax doesn't matter what income you've got here. Everybody in this example, these are hypothetical numbers. In this example, everybody's paying 14%. All right. So of course, 14% of 10,000 is less than 14% of 50,000. So the rich person is still going to pay a little bit more in this scenario. The progressive tax, the actual rate of taxation goes up as your income goes up. So poor person would pay 10% of $10,000. A rich person would pay 35% of anything over $50,000. And so that's a progressive tax. And then the regressive tax, which I just explained, is because it's a flat dollar amount generally and not a percentage, it ends up being regressive once you apply what percent of the customer's income is that. And you see that it's a bigger hit to poor people. We're going to have Mr. Thomas show you this video and this video. And I'm going to continue on here. I want to briefly give you an example of extremely regressive tax, which is the cigarette tax, the tobacco tax. Now, these are a little bit older numbers, 1973 to 2004, but in the 70s, a lot of people smoked, and the difference between the richest and the poorest was not very significant. After a lot of educational campaigns and quit smoking, it's bad for your health, Surgeon General, blah, blah, blah. By the early 2000s, smoking in general was severely cut back. But what ended up happening is that you didn't see such a drop amongst the poorest people. You saw significant drops amongst the most rich, the most affluent. And so you see this darker green as such a greater distribution of who is smoking cigarettes in our society. Well, it's mostly the poor and middle class. The rich people, not as much anymore. And so the cigarette tax burden is being borne on the rich, on the poor. But on top of that, it's also a regressive tax because it's an excise tax. It's $2 a pack in Michigan. It might be $1.60 in Pennsylvania, 87 cents in California, $1.41 in Texas. So these are flat fees added on top of every pack of cigarettes that is being paid by, again, mostly poor people. And so when a rich person does buy a pack of cigarettes, that $2 in tax is really not much to them. It's, as I use the term, it's peanuts to them, versus somebody who's poor, where they're bearing a greater burden on that. So all three taxes, if you look at them visually, the progressive tax, again, if as your income increases across the bottom here, the amount of tax that you pay increases here. So the progressive, as you probably figured out, would have the greatest hit toward rich people. The burden increases as you become richer. And if you're poor, you would say that's fair. Proportional tax is perfectly proportional. There's no slant one way or the other. Now, a rich person is going to pay a greater tax than a poor person would, but the proportion remains the same. And then the regressive taxes show that the burden eases up. It's not as bad as you get more rich. So all three of these are still in use in all portions of the United States, whether it be federal government, state government, or local governments, sales taxes, property taxes, etc. So back in 2013, during the Obama administration, these were the tax rates for the progressive income tax, tax brackets, if you will, 10%, 15%, all the way up to 39.6%, almost 40% on incomes above $400,000. When Trump was in office, he was able to get some of those taxes lowered a little bit. And so there's a little bit of change in here, 10% still, but not 39.6, 37. And the threshold to meet that 37 is a little bit higher. So that was changed a little bit. As I understand it, President Biden is going to be pushing for a return to the Obama tax brackets versus the Trump tax brackets. Okay, so that's all I'm going to cover. What I'm going to have Mr. Thomas do is load up a few more videos and that have to do with explaining how you calculate a proportional tax. I want you to pay attention to those videos, please, because tomorrow I'm going to go over a worksheet with you in class where you're going to actually calculate some taxes based on different tax brackets. And so that's what we've got. And I'm out at graduation, helping the seniors practice their graduation. Hopefully we don't get any rain tonight. We'll see you guys tomorrow.